So buying a home is a huge financial commitment that will affect your life for many years to come. Before signing up for such a big commitment, you gotta understand the numbers, right? What's going on, everyone? In this video, we're going to be talking about how much housing you can actually afford by salary. Buying a house is one of the most important decisions that people make in their lives. It involves a lot of money, time, and planning, and it can have a significant impact on your future. One of the most important questions to ask yourself before buying a house is to see how much you can afford based on your salary. Buying a home shouldn't feel like a burden or cause too much stress. Well, with the prices of homes right now, maybe that's not the case.
You're stressed.
You're stressed.
However, it's a big step we should all be excited for and look forward to. That's why for today's video, we're going to be showing you several ways to figure out how much housing you can afford based on different factors to take into account. With that being said, let's jump right into it. Step number one is to choose a framework that works best for you and one that you can stick with. In this section, I'll be breaking down 3 different frameworks you can choose from. They're a little bit similar, but there's nuances to different frameworks, and from there you can choose which one you like the most. First is the 25% rule. This is the most common guideline people follow, and that is to never spend more than 25% of your monthly take-home pay, which of course is income after tax, on monthly mortgage payments or rent. This is called the 25% rule. The reason why 25% is a number that I like is because it gives you a good amount of buffer to avoid financial stress given your other living expenses and ensures that you have enough money left over for other spending categories like utilities, groceries, insurance, and savings. My belief is that buying a home should be something that you're proud of and less of something that brings you constant financial stress. So if that means that renting is a better option for the time being given your current income levels or situation, there's nothing wrong with renting. The goal, of course, is to eventually buy a home though. Depending on where you live, keeping to the 25% rule is hard for many people right now, especially in areas where housing costs are high or where income levels aren't growing as fast. The real estate market is interesting right now because it feels like we are seeing multiple extremes running in parallel to each other. For instance, in some cities, there's a shortage of affordable housing units, which of course drives up prices and makes it harder for people to find a place that fits their budget. On the other hand, in some rural areas, there may be a surplus of housing units, but not enough jobs or services to attract people to want to live in that area. With inflation at the current levels, many people have not seen their income increase in proportion to the rising cost of living, which means they have less money left over after paying for housing and other essential expenses. To help with this, let's get into the next framework, which is backwards budgeting. Backwards budgeting is a method of managing your finances that starts with your desired savings goal and then allocates the rest of your income to your expenses. It takes into account all of your fixed and non-negotiable costs like food, transportation, or savings. Unlike traditional budgeting, which begins with your income and then subtracts your expenses and savings, backwards budgeting prioritizes your savings first and forces you to adjust your spending accordingly. So if you feel like you're not reaching your savings goals and making progress on that, then this is a great framework to follow because it forces you to save before you spend any of the money that you make from your salary. This framework doesn't only apply when you're buying a home, but also when you're renting. Overall, it's a great way to build a habit of saving first and spending second, and in some ways, it'll help you build up a down payment on your first home, all the while living within your means. Finally, we have the 30-30-3 rule. This framework has more emphasis around balanced spending. It suggests that you should spend no more than 30% of your income on housing, save at least 30% of your income for the future, and live on the remaining 40% of your salary. The final number in the framework, which is the number 3, suggests that you should never buy a home that costs more than 3 times your income, and this means if you make $50,000 a year, then you keep a budget to a $150,000 house. If you make $100,000 a year, that's $300,000, and so on and so forth. The 30-30-3 rule is not a one-size-fits-all solution, but a general framework that can help you achieve financial stability and help guesstimate how much housing you can actually afford based on the salary that you're making today while balancing out your spending and savings. Step number 2, figure out how much of a mortgage you can afford. Now that you have a guideline that's there to help you reach your personal finance goals, it's time to figure out how big of a mortgage you can qualify for. When you apply for a mortgage loan, one of the most important factors that lenders consider is your ability to repay the loan. Lenders use various criteria to determine how much they are willing to lend you, such as your income, credit history, assets, debts, and the value of the property that you want to buy. But basically the 2 main factors that lenders use to determine is income and debt. When it comes to your income, lenders will look at your income sources such as your salary, bonus, commissions, dividends, alimony, child support, and so on and so forth to calculate your gross monthly income, and they will also verify your income with documents such as your pay stubs, tax returns, W-2 forms, so on and so forth. Lenders typically use a ratio called the debt to income ratio to measure how much of your income can go towards paying your monthly debts. The lower your DTI, the more likely you are able to qualify for a higher loan amount. So it's best practice that if you're applying for a loan, definitely keep in mind of your credit utilization and how much debt you have outstanding, and compare that with the income that you're making to have a ballpark understanding of where you are in terms of your DTI. Generally, lenders prefer a DTI of 33% or less, but some may have higher ratios depending on other factors and what they actually care about when it comes to qualifying borrowers. The second thing that they look at is debt. Lenders will look at your debt such as credit cards, student loans, car loans, personal loans to determine how much you owe and how much you pay each month. Your debts affect your DTI ratio and your available cash flow. The less debt you have, the more likely you are to qualify for a higher loan amount. Generally, lenders require you to have a minimum credit utilization ratio of 30% or less, which means you should really keep your personal debt in check. Once you have your necessary documents in order and ready to apply through your lender, I recommend shopping around and comparing different lenders and loan options before applying for a mortgage loan and sticking with it. There's definitely a learning curve that comes with the mortgage acquisition process. Once you get through all the steps a lender will have you get through, they will give you a figure which is your max loan amount to purchase a home. Step number 3, figure out all the additional costs to home ownership. You might have thought that when you're buying a house, the only thing that you need to save up for is a down payment, but unfortunately, there's a lot of other additional costs, and it doesn't just end there. For example, there are closing costs to consider. When you buy a home, you have to pay for various fees and expenses that are not included in the purchase price. These are called closing costs, and they can vary depending on the type of home, the location, the lender, the seller, and the buyer. Some examples of closing costs are the following: appraisal fees, escrow fees, recording fees, loan origination fees, prepaid terms, and many other things. Closing costs can vary widely depending on many factors, but they typically range between the 2 to 5% mark of the purchase price of the home. The buyers and the sellers can negotiate who pays for which closing costs, and some closing costs can be rolled into the loan amount. But with today's hot real estate market, a lot of the closing costs end up falling on the lap of the buyer. It's important for buyers to review their loan estimate and closing disclosure documents carefully to understand what closing costs they are responsible for and how much they're paying at closing. Then you have home ownership costs that you need to take into account. Home ownership costs are the expenses associated with owning and maintaining a residential property, which is your home, of course. These costs include, but are not limited to, the following: mortgage payments, property taxes, insurance, utilities, maintenance, repairs, and improvements. Home ownership costs can have a significant impact on the financial situation and lifestyle of the owner, so it's important to plan ahead and budget accordingly and stay ahead of some of these costs that may not be top of mind at the point of purchasing. The cost of home ownership can also change over time due to inflation, market fluctuations, or personal circumstances. Therefore, it's important to review and adjust the home ownership budget from time to time and prepare for unexpected expenses or changes in income. Now, I talk about all these things not to discourage you from one day becoming a homeowner, but more so to raise your awareness when it comes to the home buying process to be ready for it when the opportunity comes. So buying a home is a huge financial commitment that will affect your life for many years to come. Before signing up for such a big commitment, you gotta understand the numbers, right? That's what this video is all about, and hopefully I emphasized it enough for you to start thinking about frameworks and different ways of getting to your financial goals. Compare different scenarios and see how everything plays out. Pick a guideline and stick to it. Also, think about your future plans and lifestyle now and in the next 10 to 20 years. Before you make an offer on your dream home, check the real cost of owning it by getting loan estimates from different lenders and rewatching this video. If this video was helpful to you, make sure you give it a thumbs up and subscribe to the channel for more content. And don't forget to share your thoughts and questions in the comment section below. So until next time, thanks for watching, and I'll catch you in the next one.